Hi, and welcome to Tax Alpha. Today we're going to look at the income tax expense that's inherent inside a personal portfolio. Many investors are keenly aware of the fees and expenses that they are being charged for the portfolio management process that they must go through. But what they do not know often is that there is a very large tax drag that is also an expense on their portfolio that they in fact can control. For example, an index or an ETF must pass through its underlying earnings in exactly the same format as originally earned. For example, a fixed income will distribute the majority of its return annually as interest income. As you know, interest income is taxed as the highest level of any investment income. Even a foreign-based index or ETF will report foreign income as earned, and this too is taxed in the same way as interest. Income tax distributions are a matter of public record. One can look at any ETF on the marketplace and see exactly what was distributed last year on a per unit basis. This information is always broken down between interest, foreign income, taxes withheld on this foreign income, dividends and capital gains, and often return of capital. With this information and the personal tax brackets of the individual involved, one can calculate the tax expense that the person is paying on holding this investment on an annual basis. This must also be added to the expenses of holding that particular investment to determine the actual after-tax return achieved. We all understand that the investor pays management fees, expenses, trailer commissions, and sometimes investment counsel fees. But what the investor often ignores again is the income tax expense, which is an additional cost to holding that investment portfolio. Oftentimes the MERs are smaller than the income tax expense involved on the distributions. For example, here are some commonly used ETFs in the marketplace. You'll notice the very low MERs, which are normally the attraction to the investor. But look at well as the annual return and the percent of this investment return lost to income tax. It's also important to see the percent of return in total lost to income tax. So in conclusion, it's all well and good to look at low MERs as an attractive way to invest in the marketplace, but do not disregard the high cost of tax on certain of these low-cost products in the ETF world. This expense must be added to the MER to give you the true cost of holding that product. Thank you for listening. I hope you enjoyed that, and we'll see you next time on Tax Alpha.